Hello my dear students, welcome everyone to this CMA final CFR revision series. In this video, I am going to revise Ind AS 36, Impairment of Assets. Ind AS 36 is one of the very important standards you have in your syllabus. Definitely you can expect one practical question and MCQ from this standard. Now before going into the main thing of Impairment of Assets, let us give you a brief idea about what is the standard is all about. Tell me, assets, whether tangible or intangible, are subject to any kind of losses. What is the most traditional loss of an asset? Depreciation. Everybody knows this. Depreciation or amortization. So, over the period of time, because of usage, afflection of time, wear and tear, an asset may loses its value. In case of tangible assets, we call this as depreciation. Intangible assets, we call this as amortization. Of course, these are the traditional losses we know, and this is covered under the respective standard PPE for tangible assets. Intangible assets, there is a separate standard. Now, apart from depreciation or amortization, is there any reason why an asset may loses its value? There could be. There could be different reasons why an asset may loses its value, apart from depreciation and amortization. Now, that may be technically called as impairment loss. So, to put it simply, what is impairment loss? Loss in value of an asset due to reasons other than depreciation. Other than depreciation, there could be some other reasons why an asset may loses its value. So, whatever the reduction in the asset, that may be technically called as impairment loss. Okay. Now, what we are going to cover in this standard? So, there are objective, scope, definitions, identifying an asset that may be impaired, the indicators for impairment, measurement of recoverable amount, recognizing and measuring an impairment loss, that is accounting treatment, cash generating unit, and reversal of impairment loss. So these are the topics we had. Now objective. So what is the object of this Ind AS 36? Simple, to provide the accounting treatment of impairment loss and how to recognize impairment loss and what is the accounting treatment for reversal of impairment loss. All these things, the principles relating to impairment loss are covered under the topic of objective. Not much important. Now scope. Very, very important, sir. Scope. Sir, whether this standard impairment of assets is going to apply for all the assets? The answer is no. There are some exceptions. This standard shall be applied in accounting for impairment of all assets other than inventories, because we have Ind AS 2. Deferred tax assets, Ind AS 12. Assets arising from employee benefits, Ind AS 19. Biological assets relating to agriculture activity, Ind AS 41. Financial assets within the scope of Ind AS 109, financial instruments. Non-current assets held for sale, Ind AS 105. Contract assets, Ind AS 115. Deferred acquisition cost and intangible assets arising from insurance contracts, Ind AS 104. See, always remember, when you have a specific Ind AS, okay, follow that. Don't follow the general Ind AS, general standard. The impairment loss is a general standard. But for any particular asset, if there is a specific standard, so definitely you need to follow that specific standard. That's why inventories, deferred tax assets, assets arising from employee benefits, biological assets relating to agriculture activity, financial assets, non-current assets held for sale, contract assets, any deferred acquisition cost and intangible assets arising from insurance contracts, these are not covered under this standard. And also here one important point, sir, this standard shall also be applied to financial assets like investment in subsidiaries, associates, joint ventures. Even investment in subsidiaries, joint ventures, associates also covered under this standard. Remember this. Okay. So this is the scope of this standard. Now the main thing of this standard. There, first of all, this standard says or how to identify an asset is subject to impairment loss. See, there are actually certain indicators that this asset may be subject to impairment loss. Okay. First of all, how to calculate impairment loss? Two things you need to compare. First thing is carrying amount of an asset. And second thing is recoverable amount of an asset. On one hand, carrying amount, on the other hand, recoverable amount. If the carrying amount of the asset is greater than recoverable amount, then we say, or the excess of carrying amount over recoverable amount, we call it as impairment loss. So first of all, I want every one of you to remember these things. What is impairment loss? Carrying amount minus recoverable amount. This is the thing, main thing. Because the main intention of the standard is the value at which you are showing the asset in your books should be restricted to its recoverable value. It should not be more than that. Suppose the value at which you are showing the asset in the books is more than recoverable value, that means there is a kind of overvaluation of your asset. So that over amount you should reduce. That we call it as impairment loss. Okay, so what is the formula for impairment loss? Carrying amount minus recoverable value. Now the question is, sir, how to calculate carrying amount? Simple. Carrying amount is equal to take the cost of the asset, from that reduce accumulated depreciation. On which date you are calculating the carrying amount? Till that date, what is the depreciation accumulated on the cost of the asset, original cost of the asset? You reduce it. And any accumulated impairment loss, already you have provided impairment loss previously, that keep on accumulating impairment loss also you deduct, then you will get the carrying amount. Suppose this is the first time you are calculating impairment loss, then this accumulated impairment loss will not come. Only cost of the asset minus accumulated depreciation. So how to find out the carrying amount? Cost minus accumulated depreciation minus accumulated impairment loss if the asset is already subject to impairment. Suppose previously no impairment has been done. This is the first time you are checking the asset for its impairment loss. Then how to find out the carrying amount? Cost of the asset minus accumulated depreciation. Now, the next thing is recoverable amount, because carrying amount is compared with recoverable amount. The standard says recoverable amount is equal to higher of the following. First one, fair value after reducing the cost of disposal. So that means the normal selling price in the market, or nothing but NRV. If I sell this asset right now in the market, how much amount I am going to get? That is called fair value after reducing the cost of disposal. Here the important point is, at the time of sale, whatever the cost you are going to incur to make the sale happen, those costs shall be reduced. That is one aspect. Second thing is value in use. So A, fair value less cost of disposal. B, value in use. Whichever is higher you take, then you will get recoverable amount. So can you tell me the formula for recoverable amount? Recoverable amount is equal to fair value less cost of disposal or value in use, whichever is higher. Now fair value, nothing but if I sell this asset right now in the market, how much I am going to get? Easily we can know. And from that cost of disposal, how to find out value in use? Standard says value in use is nothing but the present value of the expected future cash flows from the asset. So the asset in respect of which you are calculating the impairment loss, from this asset, what is the present value of expected future cash flows from this asset? So the asset in respect of which you are testing impairment loss, you need to see what are the expected cash flows from the asset. From that, that expected cash flows, if you convert into the present value, then you will get value in use. So tell me, what is value in use? Present value of the expected future cash flows from the asset. Okay. So therefore, in summary, impairment loss is equal to carrying amount minus recoverable value. Carrying amount is equal to cost of the asset minus accumulated depreciation minus accumulated impairment loss. Recoverable value is equal to NRV, nothing but the fair value less cost of disposal or value in use, whichever is higher. Value in use is equal to present value of the future cash flows. Okay. Now the question is, sir, you said we need to now find out the carrying amount as well as recoverable amount. Recoverable amount having two aspects. One is fair value less cost of disposal. Next one is value in use. Value in use is nothing but what? Present value of the expected cash flows. Sir, how to calculate the expected cash flows? See here, future cash flows. The standard says inclusions. What are the things we need to consider? exclusions. What are the things we should not consider as a part of expected future cash flows? What are the things we will consider? Continuing use of the asset, inflows and outflows. Now the asset in respect of which we are ascertaining the future cash flows, from that asset, what are the inflows we are expecting? What are the outflows we are expecting? So that you need to consider as a part of the future cash flows. Second important thing is, at the time of disposal, what is the net sale proceeds this asset is going to generate? That is also to be considered as a part of the future cash flows inclusions. So suppose the life of the asset is 10 years. After the 10 years, if I sell this asset in the market, how much I am going to get? That it kind of a residual value. But remember, you have to reduce the cost of disposal. Now, the net sale proceeds will be considered as a part of the future cash flows. But important here is, there are some exclusions which we will not consider as a part of the future cash flows. So they might coin one question. So what are the, I mean, they may give in a practical question, there may be a exclusion point. So you should remember this is not part of the future cash flows. Like for example, income tax receipts and payments. Sir, the asset in respect of which you are calculating the value in use, future cash flows, any tax you paid or any tax refund you got, you should not consider it. Second, improving asset performance. Any cost you incur to increase the asset performance. So, for example, you might replace the existing engine of an asset with the high capacity engine. Now, that might improve the asset performance, but that kind of a cost should not be considered as a part of the future cash flows. Next, future restructuring cost or benefits. Suppose the asset in respect of which you are going to incur some cost to remove it, to dismantle it, but that cost you have not committed yet. So that cost also should not be considered. Future restructuring cost not yet committed. This is important here. Not yet committed. And next one, cash inflows and outflows from financing activities. So what is financing activities, sir? Financing activities is nothing but activities relating to borrowings. Suppose for example, you have taken a bank loan. By using that loan, you purchase the asset. Now in respect of that asset, you are calculating the future cash flows. Now, whatever the borrowings you have made in respect of that asset, on those borrowings, whatever the interest you are paying now, that interest we should not consider as a part of the future cash flows of this asset. So that is called cash inflows and outflows from financing activities. So everybody remember, when you are calculating the future cash flows, what are the inclusions, what are the exclusions? First, inclusions. Inclusions, continuing use of the asset, inflows and outflows. And at the same time, if I sell this asset at the time of disposal, what is the net sale proceeds I am going to get? So these are the two things. Exclusions. So there are certain exclusions. One is income tax receipts and payments. You should not consider. Second, improving asset performance. Any cost you incur to improve the asset performance should not consider. Future restructuring cost which is not yet committed in respect of this asset, we should not consider. And any cash inflows and outflows in respect of the financing activities, we should not consider. So this is how you need to calculate. So therefore, I have given you an overall view. So understand. First, impairment loss is equal to carrying amount minus recoverable value. Carrying amount is equal to cost of the asset minus accumulated depreciation minus accumulated impairment loss. Recoverable value is equal to fair value less cost of disposal or value in use, whichever is higher. Value in use is equal to present value of the expected cash flows of the asset. When you are calculating the future cash flows, what are the inclusions? So what are the inflows and outflows from the continuing use of this asset, and what is the net sale proceeds at the time of at the end of the life of the asset if I sold it? So these are part of the inclusions. Exclusions, income tax receipts and payments, any cost incurred to improve the asset performance which enhances the asset's capacity or performance, and future restructuring cost. So these are should not, and any cash inflows or outflows relating to financing activities we should not consider. Okay. Sir, you said impairment loss formula, how to calculate all these things you said. But for which asset there is an impairment loss, how to calculate? See, for every asset, what is the carrying amount? What is the recoverable amount? Carrying amount is more than recoverable amount. So therefore, there is an impairment loss. Very difficult, na? So that's why standard has provided certain indicators. Now these indicators, in respect of any asset, if any one of these indicators is there, now at the end of the year, definitely you need to test that maybe that asset is subject to impairment loss. So for that asset, you need to calculate the carrying amount as well as the recoverable value. If the carrying amount is more than recoverable value, obviously there is a loss, impairment loss. Therefore, the asset value must be reduced. Because the intention of the standard is that assets capable worth is recoverable value. But in your books, you are showing more than that. That means there is a overvaluation of the asset. So that has to be brought down. That bringing down the asset, reducing the asset value will technically called as impairment loss. So can you tell me what are the indicators? Yeah. So if any one of these indicators you found, then in respect of that asset, you need to check whether that asset is subject to impairment loss or not. Actually, indicators for impairment are divided into two parts: internal, external sources. Let us see first internal sources. Obsolescence or physical damage of an asset. Suppose an asset is damaged, subject to accident. Suppose there is a fire and our plant and machinery got destroyed, or our plant and machinery partially destroyed. Now tell me, so that could be definitely one of the indicator, internal information. This asset, so subject to damage, so subject to accident. Now you are showing the asset value in the books, compare with recoverable value. If this asset after demolition, after destruction, what is the worth of this asset? And right now at what value you are showing? Carrying amount, recoverable value, compare. If your carrying amount is more than the recoverable value, now you need to bring down the carrying value to recoverable value. Now when you bring down the asset value, that bringing down, that to the extent you want to reduce the asset value, that is called impairment loss. So the first internal sources of information for impairment loss is physical damage of the asset. If any asset is subject to physical damage, immediately you need to test at the end of the year for its impairment. Similarly, significant changes in the use or expected to be used of an asset with an adverse effect on entity. Suppose you want to make a significant change in the use or expected to be use of an asset, which will have an adverse effect on the entity. Please understand, which will have what? Adverse effect on the entity. See, suppose for example, you have one plant and machinery. That plant and machinery right now you are using for production of one item. Now you want to use the same plant and machinery for production of another item also. Now for that you made little bit modifications. Now after that what happens is this asset, the quality of item number 1 has been decreased. The moment you started using this plant and machinery for item number 2. So because of the small modifications you have done. So that means significant changes in use are expected to be use of an asset. Of course, significant changes in the use are expected to be use of an asset. Suppose that asset capability is 1 lakh units. Okay, 1 lakh units per month. Now right now you are producing only 50,000 units. Now you want to increase this output to 90,000 or 1 lakh units. That means significant change in the use are expected to be use of an asset. And that is having an adverse effect on the entity. So definitely because of your change in the expected use of an asset have a negative impact on the organization. Then that could be an impact. So that could be a reason for checking impairment loss. And also our internal reporting indicating worst economic performance of the asset than expected. So our internal report suggests that our performance is worse than expected. For example, we thought this asset is capable of generating 10,000 units per month, but it is generating only 5,000 units. So quality units, 5,000 units. So remaining all or some defect is there. That means internal reporting indicating worst economic performance of the asset than expected. So that could be one of the reasons. And also there could be some external sources of information. So outside information, significant decline in the market value other than normal decline. Suppose any asset market value has been declined significantly. For example, Nokia company, you see, actually in the beginning they are the manufacturers of mobile phones. So simple mobile phones. Now with the introduction of smartphones by Samsung and other companies, the Nokia has lost its value. So there is a significant decline in the market value. Now the moment your company loses its market value, definitely you have to check whether the assets are subject to impairment loss or not. Because you may show your asset value at one value, but right now in the market these assets may not have that much value. So therefore this is one of the external information. So if you find there is a significant decline in the market value, of course normal decline is okay, more than normal decline, then you say you have to test this asset for impairment. Similarly, any significant changes in the technology, market, economic, legal environment with adverse effect on entity. Of course, all these cases you need to see adverse effect only. Then only you can book the loss. So significant changes in technology, market, economic or legal environment. So best example could be Kodak. So previously So Kodak company used to sell the reels. So camera, we used to take photos by using these reels. But nowadays with the introduction of smartphones and gadgets, so what happens is these reels does not have any importance. So Kodak loses its market value. So significant changes in technology, market, economic, legal environment with adverse effect on entity. For example, your competitors are introducing online e-commerce platform, but you are not selling your products on online. Only physical stores you are maintaining. So definitely it will have an adverse effect because there is a significant changes in the market, economic, legal environment. For example, government has brought changes in the law. So which is exactly, have an adverse effect on the products you are manufacturing. So that could be one of the reason. So these are all the negative factors which will directly impact your business. And increase in market interest rate or rate of returns. Suppose if there is an increase in market interest rate, that could be one of the external information. See, generally, for example, you take a real estate sector. So people used to buy properties by taking loans. Suppose when the cost of interest is increasing, when the rate of interest is increasing, majority of the people are not interested to go for borrowings when there are high rate of interest. So therefore, when the interest rates are increasing, real estate companies has to check for impairment. Definitely their value will decrease, their business will decrease, so their assets value may come down. So therefore understand this increase in market interest rate. So these could be some of the reasons why an asset, indicators for impairment. So an asset is subject to impairment because of any one of these indicators. Now, apart from internal and external sources of information, sir, investment in subsidiary, joint venture and associate. I told you financial assets are also covered under this standard. Of course, this investment in subsidiary, joint venture, associate, you will better understand in business combination chapter better. Okay. And see, standard has provided certain items required to be treated for impairment at least annually. That means once in every year, you have to check whether these assets are subject to impairment, whether there is an indicator or not. Please understand. Generally, if the indicator is there, whether internal indicator, external indicator is there, we need to check the carrying amount, recoverable value. If the carrying amount is more than recoverable value, we say there is an impairment loss. But there are certain assets which is prescribed in the Ind AS, irrespective of whether there is an indication of impairment. An entity is required to test the following items for impairment at least annually. So once in every year, they need to test the following items for their impairment. What are the things? They may ask MCQ. Any intangible assets with an indefinite useful life. One, intangible assets not yet available for use. That means in R&D stage, research and development stage. So any intangible assets not yet available for use. And the last one is goodwill acquired in business combination. So we have separate chapter called business combination. So generally when you acquire any business, so at the time a goodwill may create it. So that is goodwill acquired in business combination. So that is also to be tested annually for the impairment. Okay. So these are the three assets which is tested for impairment at least annually. And one more interesting point, sir, here, future currency cash flows. Suppose, sir, when you are calculating the value in use, I told you value in use is equal to present value of the expected cash flows. Suppose your cash flows of the asset is in foreign currency, then suppose your asset is in foreign country. Now that asset is generating cash flows in foreign currency. Then how to calculate? Simple. Whatever the cash flows are there in foreign currency, so discount them using the, first of all, discount them into the present value. After that, convert them into the Indian rupees by using the spot exchange rate on the date of conversion, on which date you are calculating the value in use. Here, future cash flows are first estimated in the currency in which they will be generated. For example, our cash flows, future cash flows are in dollars, and then discounted using a discount rate appropriate for that currency. Convert them into the present value first. Don't convert them into rupees, because we have a separate problem for this. There is a question also I have given in my question bank. So suppose, for example, my future cash flows is $10,000. First, discount them into the present value. For example, the discounting rate is 10%. So convert them into the present value. After that, an entity translate the present value using the spot exchange rate at the date the value in use calculation. After that, you try to convert them into Indian rupees by using the spot exchange rate. That is, spot exchange rate means the exchange rate on the date of translation, on which date you are finding the value in use. So this is also one point. Okay. Now the next thing is accounting treatment. Sir, what is the accounting treatment for impairment loss? Simple. You need to ask one question. The asset in respect of which you are calculating the impairment loss or checking the impairment loss, whether that asset is previously revalued or not. Or is there any revaluation surplus in respect of that asset? Is it already revalued? Is there any revaluation surplus existing in respect of that asset? The answer could be either no or yes. If it is no, simply whatever the impairment loss you got on that asset, transfer to P&L account. So the asset in respect of which you are calculating impairment loss, is any revaluation surplus existing in regarding to that asset? No, sir. Then total impairment loss will be transferred to P&L account. Now, suppose answer is yes, sir, the asset in respect of which we are calculating the impairment loss is previously revalued, sir. So there is a revaluation surplus. Now, what standard says is, to the extent of revaluation surplus, recognize in other comprehensive income. Any impairment loss in excess of the revaluation surplus, then debit to P&L account. Suppose for example, revaluation surplus 20 lakhs, impairment loss 30 lakhs. Now the standard says, first this impairment loss of 30 lakhs, 20 lakhs will be adjusted from revaluation surplus, only remaining 10 lakhs will go to P&L account. That means, can you tell me what is the entry for impairment loss? Simple. Impairment loss account data to asset. You are reducing the asset value. Okay. Suppose for example, carrying amount of the asset 50 lakhs, recoverable value 40 lakhs. So carrying amount minus recoverable value, that means impairment loss 10 lakhs. So therefore, carrying amount 50 lakhs minus impairment loss 10 lakhs. So 40 lakhs. What is this? This is the revised carrying amount of the asset. Revised carrying amount of asset. Now this 10 lakhs will go to P&L account. And suppose for example, if the asset in respect of which we are booking impairment loss, if there is a revaluation surplus, what is the entry? Simple. Impairment loss account data to asset. Then this impairment loss will be adjusted against the revaluation surplus and P&L. So revaluation surplus account debit, in our example 20 lakhs, P&L account debit 10 lakhs to this impairment loss 30 lakhs. So this is the treatment of impairment loss. Now here important point, sir. So the asset in respect of which there is a revaluation surplus, and if you calculate any impairment loss in respect of that asset, first you need to, to the extent of revaluation surplus, you need to recognize in other comprehensive income. What is this other comprehensive income? See, if you, as per the Indian accounting standard, when you prepare any P&L account, or as per the schedule of the Companies Act, when you prepare a P&L account, you have incomes, you have expenses. Incomes minus expenses, you will get a profit. Now, after that, there are some below the line items, which is not directly affecting the incomes and expenses. They comes under OCI, other comprehensive income. Now, this revaluation surplus generally will be covered in OCI. So that's why here I have written OCI. But you remember that whenever there is an impairment loss, in respect of which there is a revaluation surplus, so first to the extent of revaluation surplus, so you adjust, and then anything in excess will be debited to P&L account. So this is the chart I have given, sir, for the accounting treatment. Now see, till here one aspect of Ind AS 32, sir. Sorry, Ind AS 36. Now let us see some questions relating to impairment loss, whatever we have discussed till now. A Limited has problem number 1. A Limited has a machine whose original cost 45, accumulated depreciation on the machine 15,000. A similar machine has recently been sold in the same locality at 25,000 with selling expenses 2,000. Management determined the entity specific present value of future cash flows of the machine 28,000. Find fair value less cost to sell. So what is the fair value less cost to sell? What is fair value? Fair value means here, if I sell this asset in the market right now, what is the amount I am going to get? See here, a similar machine recently been sold in the same locality 25,000. So 25,000 less cost to sell 2,000. So therefore, can I say 23,000? So fair value less cost to sell 23,000. Now the second one is recoverable amount. What is recoverable amount? Recoverable amount is equal to two things. What is that? Fair value less cost of disposal, cost of sell, or present value of the future cash flows, whichever is higher. So on one hand, fair value less cost of disposal, which we already calculated, 23,000. B, present value of the future cash flows, 28,000, whichever is higher. Whichever is higher means 28,000. So answer is 28,000. And what is impairment loss? Can you tell me how to calculate impairment loss? Impairment loss is equal to carrying amount minus recoverable value. What is the carrying amount of the asset? Actually, original cost 45 minus accumulated depreciation 15. So 45 minus 15. So it is 30,000. Minus recoverable value 28,000. So carrying amount is more than recoverable value by 2,000. So therefore, this 2,000 will be our impairment loss. Carrying amount of the machine after impairment. So what is the original carrying amount of the asset? 45 minus 15, 30,000 minus impairment loss you need to deduct. So therefore now the asset value is 28,000. This is the revised carrying amount of the asset. So these are the answers. Next, question number 2. Venus Limited as an asset which is carried in the balance sheet on 31st March 2011 at 500 lakhs. As on the date, the value in use is 400, fair value less cost to disposal 375. From the above data, calculate impairment loss. Can you tell me what is impairment loss here? What is the value in use? What is the carrying amount of the asset? 500 lakhs. Okay. 500 lakhs. What is the recoverable value? Recoverable value is equal to fair value less cost to disposal 375 or value in use 400, whichever is higher. So 400. So 500 or 400. So sorry, 500 minus 400. 500 minus 400. Carrying amount minus recoverable value, that is 100 lakhs is the impairment loss. So 100 lakhs is the impairment loss. And they're also asking the entries. What is the entry, sir? Simple, impairment loss to asset, then P&L to impairment loss. Okay. Now next. So you can also see problem number 5. Mars Limited gives the following estimate of cash flows relating to PPE on 31st March 2014. Discount rate 15%. So the expected cash flows of the Mars Limited given, sir. Actually, they are giving you the details as on 31st March 2014 relating to the future cash flows. So 14, 15, 15, 16, 16, 17, 17, 18, 18, 19, residual value 500 at the end. Property, plant, equipment was purchased on 1st April 2011 for 20,000 lakhs. Useful life 8 years. Residual value estimated at the end of 8 years 500 lakhs. Fair value less cost to disposal 10,000 lakhs. Calculate impairment loss if any on the property, plant, equipment. So can you tell me how to calculate impairment loss? Carrying amount minus recoverable value. What is carrying amount here? Simple. When you have purchased the asset 1st April 2011. So what is the cost of the asset? 20,000 lakhs. Cost of the asset 20,000 lakhs. So carrying amount 20,000 lakhs cost of the asset minus. So 11, 12, 12, 13, 13, 14. So 3 years are over. Because you need to calculate impairment loss on 31st March 2014. So 11, 12, 12, 13, 13, 14, 3 years. And useful life is 8 years. So therefore, can I say 20,000 minus residual value 500. This is depreciable amount divided by 8 because 8 years into 3. So you will get so 19,500 divided by 8 into 3. So 7312.5. So therefore 20,000 minus 7312.5. So 12,687.5. What is this? This is the carrying amount of the asset. See here. 12,687. They round it off. 12,687. Now I need to find out the recoverable value. How to get recoverable value? Fair value less cost of disposal given 10,000. Value in use. What is the value in use? Present value of the expected cash flows. So they have given the expected cash flows. Convert them into the present value. And one important thing I told you, when you are calculating the expected cash flows, even you need to consider the net sale proceeds. If I sell this asset at the end of the life, what is the amount I am going to get? That is also part of the future cash flows. Therefore, this residual value of 500 should also be considered. So therefore, they have converted this into present value. See the last year, they have considered 2500. 2000 is the cash flow plus 500 residual value. And they converted into the present value, that is 9513. So therefore, fair value less cost of disposal 10,000 or present value of the future cash flows, that is value in use 9513, whichever is higher, that is 10,000. So compare 12,687 recoverable carrying amount, 10,000 recoverable value, whichever is excess of carrying amount 2,687. This is impairment loss. Now this impairment loss we need to reduce from the carrying amount of the asset, 12,687 minus 2,687. Now it will be 10,000. Now this 10,000 will be depreciated over the remaining life. Actually 8 years is a life now. Out of the 3 years is already over. So therefore, after the impairment loss, whatever the revised carrying amount of the asset is there, that revised carrying amount has to be depreciated over the remaining life. So that means 10,000 minus residual value 500 divided by 5 years. See here. So 1900 will be the impairment loss. So these are some basic problems relating to impairment loss. Now, next what we need to discuss is the remaining concepts of this standard cell. Now next in this standard we need to discuss about cash generating units. Now the next area of discussion in Ind AS 36 is recognition and measurement of impairment loss for cash generating unit and goodwill. So first of all, how to identify cash generating units? So CGU concept, sir. What is this CGU concept is all about? See, sometimes we will treat group of assets together as one unit and we will test the impairment for that group. Sir, why we will do this? See, it is very difficult to find out the recoverable value of each individual asset. It may not be possible to estimate the recoverable amount of the individual asset. Then an entity is required to determine the recoverable amount of the CGU to which the asset belongs. So individually you cannot determine the cash flows of that particular asset because it cannot generate independent cash flows. Then how to find out the recoverable amount? Without finding recoverable amount, it is not possible to say whether there is an impairment loss or not, because we will compare carrying amount with recoverable value. When the carrying amount is more than recoverable value, then we say there is an impairment loss. But here, to find out the recoverable value, two things are required: fair value less cost of disposal. Second thing is value in use. Value in use means nothing but how much is the future cash flows from this asset. But this asset alone cannot generate cash flows. So that's why finding recoverable amount of each individual asset may not be practically possible. Then how to test the impairment of that individual asset? That's why they brought the concept of CGU. If it is not possible to test the impairment at individual level, then test the impairment in CGU, cash generating unit. That means the cash generating unit to which this asset belongs. So what is cash generating unit? Simply nothing but a group of assets together which generate cash flows. So cash generating unit is the smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets or group of assets. So group of assets together generating cash flows which are purely independent of the cash flows generated by other assets or group of assets. For example, there is a retail chain. You take DMart or you take Reliance. So they are operating retail chain. They are having retail outlets. So in each city, they may have one retail shop, retail outlet. So they can treat that retail outlet as one cash generating unit. So that outlet may have equipment, furniture, fixtures, machinery, everything. But what you need to think is, each individual asset may not generate cash flows by itself. In such a situation, entire outlet can be treated as one asset, one unit. It may have number of assets within it. But is it possible to test the impairment of each individual asset? No. Why? Because they alone cannot generate cash flows. So in such a situation, you need to test the impairment at a group of assets level, not at individual level. So that group of assets which together generate cash inflows, technically called as CGU. So CGUs can be an entire entity sometimes. A CGU can be a department within the entity, within the organization. One entire department can be treated as one cash generating unit. Suppose production department, marketing department, finance department. So they can treat it as one separate CGU, cash generating unit. Next, production line within a department or within an entity. So within a department, there is one production line. So which is exclusive deal with a particular kind of products or group of products. That can be treated as cash generating unit. So ultimately, group of assets together can be treated as one unit, CGU, that is called. And you need to test the impairment of that individual asset. Impairment testing which is not possible for an individual asset will be tested for impairment in the group, in the CGU. That is the main intention here. So the whole idea of this standard is what? Asset can be subject to impairment. So how to calculate? Carrying amount minus recoverable value. But finding recoverable value may be difficult. That's why individual level not possible, but at group level may be possible. That's why. See here one example I have given. So there is a mining operations going on, sir. So they have laid on one private railway track to transport the mine, whatever excavated from factory, from the mining to their factory. Now you tell me, this private railway is their asset, right? Now it alone cannot generate cash flows, this private railway track, but it is part of the entire operation. So therefore what they are saying is entire mine can be treated as one CGU. In that mine, in that CGU, this private railway asset will also part. So therefore private railway, it may not be possible for us to test for impairment individually because it cannot generate cash flows independently. But when you treat it as a part of the group, when you treat it as a part of the mine as a whole, then you may treat for impairment, because the entire mining operation is one asset. What is the carrying amount? What is the recoverable value? You can easily find out. What is the value in use? As a mine as a whole, I can determine. That's how. So individually may not be possible, but as a group it is possible. That's the idea. Okay. So the private railway could be sold only for scrap and does not generate cash inflows on its own. That means it is not possible to find out the recoverable amount. It is not possible to estimate the recoverable amount of the private railway because its value in use cannot be determined and is probably different from scrap value. Therefore, the entity estimates the recoverable amount of the CGU to which the private railway belongs, that is the mine as a whole. Hope you guys are understanding what is cash generating unit. Suppose there is a hotel, Taj Group is there. Now Taj Group is having hotels in different cities, right? So each city hotel, whatever they had, they can treat it as one CGU, because in that hotel there can be number of assets. Each asset may not independently generate cash flows, but together when you look entire hotel as one unit, so it encompasses everything, right? So then you can test the impairment of the entire group. Individually it may not be possible. So but in this situation, that's why they are bringing the concept of group of assets. So CGU. Okay, so that we can easily test the impairment at individual level, as well as if it is not possible at individual level, then group of assets can be tested for impairment. Now here two things you need to focus. One is goodwill, another one is corporate assets. See, goodwill and corporate assets both are tested for impairment at CGU only, not at individual level. Because you tell me goodwill, Can goodwill, is goodwill belongs to one particular department or one particular asset? No, generally goodwill belongs to entire organization, right? So therefore, when I want to test the impairment of goodwill, so what I need to do is I can't test it independently, because goodwill is a factor which will give intangible push or intangible benefit to every department, every entity within the organization. So every department, every product line in the organization. Similarly, corporate assets. What is corporate assets? The head office headquarters, or head office brand value, or head office IT infrastructure. So head office level assets. So these assets also, they can't particularly belongs to one particular thing. So they will, I mean, these corporate assets will be beneficial to different uh, departments, different products, different branches within the organization. So therefore, what we need to do is, first thing you need to remember, goodwill, that too goodwill which is acquired in business combination. So when you acquire any company, when you invest in any company, so in that process, whatever the goodwill you generated, so that goodwill and corporate assets, they cannot be tested for impairment individually, because they cannot generate independent cash flows. Alone, they cannot generate. They will just contribute. Since goodwill and corporate assets contribute other assets in generating cash flows. So impairment of goodwill and corporate assets when done in CGU only. First we talk about a goodwill. So in the question, suppose they have given cash generating units, they will give, and they will give goodwill of the organization. What you need to do is, you need to allocate this goodwill to different CGUs. I told you, na, goodwill generally will contribute to the overall organization. Therefore, goodwill will belongs to all CGUs. So whatever the goodwill you have, you need to allocate between the CGUs. Sir, in what ratio? So goodwill is allocated to different CGOs in the ratio specified in the question. They will specify. Suppose if the ratio is not specified, then you allocate in the following manner. First, take the fair value of the CGU. Cash generating unit 1, what is the fair value? Cash generating unit 2, what is the fair value? Cash generating unit 3, what is the fair value? Based on the fair values, this goodwill you allocate. If that is not available, then ratio of CGU, that is carrying amount and useful life of the product. If that is also not available, carrying amount of the CGU on the date of impairment. Not that much important. 99% of the times they will give you the ratio. They will specify the ratio, how goodwill is allocated between the CGUs. So whenever you find cash generating unit question, what you need to do is, whatever the goodwill appearing in the question, that goodwill you need to allocate between the CGUs in the ratio which is specified in the question. That's it. Now coming to the next one, corporate assets. So corporate assets also, what we need to do is, we need to test the impairment at CGU level, not at individual level. So therefore, whatever the corporate assets the organization had, first we need to allocate between the CGUs. So how we need to allocate? First of all, we need to identify the corporate assets. What are all the corporate assets we had? Examples of corporate assets, suppose company headquarters can be a corporate asset. Company centralized IT infrastructure can be a corporate asset, or company overall brand, that can be a corporate asset. So first identify what are the corporate assets you had. Second, allocate these corporate assets between the CGUs. How you are going to allocate it? So assess whether a portion of the carrying amount of the corporate assets can be reasonably and consistently allocated to the CGU. If yes, allocate the portion to CGU. So this corporate assets belongs to which CGU? If you can reasonably and consistently allocate, this corporate asset may belongs to this group, this CGU. So these are all together generating cash flows. Then if you feel like that, you allocate it. Okay. If no corporate asset is not part of the CGU for impairment testing. Suppose if you feel this corporate asset is not reasonably consistently allocated to CGU, don't allocate it. Don't test it for impairment also. That is what the standard says. And then once you allocate corporate assets to CGUs, then you check the cash generating unit carrying value with recoverable value. And tell me when impairment loss will come. When carrying amount is more than recoverable value, impairment loss exists. If carrying amount is less than recoverable value, no impairment loss. Now suppose if there is an impairment loss for the CGU, what you need to do next is, whatever the impairment loss came, that first reduce goodwill allocated to the CGU first. This is important, sir. Sir, whenever you find out impairment loss for the cash generating unit, this impairment loss first used to reduce the goodwill which is allocated to the CGU. After that, still if there is any impairment loss, okay, then allocate the impairment loss to the remaining assets based on their carrying values. That means the remaining impairment loss will be reduced from the other assets based on their carrying values. So this is how you need to do. How you need to going to allocate the corporate assets. I will solve one questions relating to it so that you will understand, sir. Problem number 8, sir. See this question. ABC Limited has 3 cash generating units. A, B and C. 3 cash generating units A, B, C. They are given in the question itself. Generally they will specify what are the cash generating units. The carrying amount of which on 31st March 2011 are as follows. So their carrying amounts are given. Cash generating unit A, carrying amount 500. Remaining useful life 10 years. Okay. So carrying amount rupees in crores. Cash generating unit B 750 crores 20 years. Cash generating unit C 1100 crores 20 years useful life. Next, what happened? ABC Limited also has 2 corporate assets C having remaining useful life of 20 years. 2 corporate assets at the head office level. Corporate asset X, corporate asset Y. Now what we need to do? Tell me. Whenever you find cash generating units, corporate assets, these corporate assets will be allocated to cash generating units and impairment loss will be tested for the CGU. Now here, what are the corporate assets? XY. X carrying amount 600 crores. But remarks, the carrying amount of X can be allocated on reasonable basis. That is pro rata basis to the individual cash generating units. So this corporate asset X 600 crores we need to allocate between the carrying amount of the ABC. Okay. But when it comes to carrying asset Y, corporate asset Y 200, the carrying amount of the Y cannot be allocated on reasonable basis to the individual cash generating units. So the standard itself said, just now I have discussed, when you are unable to reasonably consistently allocate any corporate asset to the individual cash generating units, then don't allocate. So therefore here you need to ignore Y, because in the question clearly said that Y cannot be allocated on reasonable basis to the individual cash generating units, but X can be allocated. And the recoverable value of the each cash generating unit they have given A, B, C. So once you know the carrying amount, you can compare with the recoverable value. If the carrying amount is more than the recoverable value, there is an impairment loss. So calculate the impairment loss. So here tell me how to calculate impairment loss. So first take the carrying amount of the CGUs. 500, 750, 1100. Then allocate corporate asset X, because corporate assets cannot be tested for impairment individually. Their impairment loss will be tested as a part of CGU. So therefore this corporate asset X will be allocated between the cash generating units. Now how you are going to allocate it? See here. So this is question number 8, sir. Yes. So first they have taken the carrying amount of X, A, B, C. See here. 500, 750, 1100. Total 2350. Useful life also given in the question. 10 years, 20 years, 20 years. So weights 1, 2, 2. Based on the useful life. If you see the weights, 1 is to 2 is to 2. Because 10 years, 20 years, 20 years. So 1 is to 2 is to 2. 10 is to 20 is to 20. Useful life. So 1 is to 2 is to 2. Okay. Now what is the carrying amount after assigning weight? I am multiplying carrying amount with weights. 500 into 1, 500. 750 into 2, 1500. 1100 into 2, 2200. Total 4200. Now corporate asset X. Allocate this X between these assets. So how they are allocating, sir? What is the value of this corporate asset X? 500. Sorry, 600. Right. Now this 600 we should allocate. On what basis you will allocate, sir? Find out the percentage, sir. Pro rata allocation of X. Out of 4,200, 500 is the cash generating unit A. So 500 divided by 4,200, 12%. 1500 divided by 4,200, 36%. 2,200 divided by 4,200, 52%. So now allocate X between A, B, C based on this ratio. So 12%, 36%, 42, 52%. So 600 is allocated. 600 into 12%, 72. 36%, 216. 52%, 3112. Now once you allocate the corporate assets to the cash generating units, what is the carrying amount? Here 572, 500 plus 72, 216, 750 plus 216, 966, 1100 plus 312, 1412. So this is the carrying amount. So once you know the carrying amount, 572, 966, 1412, compare with recoverable value. Recoverable value they have given in the question. See here. So recoverable value A 600, B 900, C 1400. 600, 900, 1400. Compare. So carrying amount greater than recoverable value. In cash generating unit A, carrying amount only 572, but recoverable value 600. So there is no impairment loss. Impairment loss is 0. When impairment loss will come, sir? When carrying amount is greater than recoverable amount. Now come to B, 966, 900. Because you are showing 966, but actually recoverable value is 900. So impairment loss is 66. Similarly, come to C, 1412. Okay, 1400 is the recoverable value. So 12 is the impairment loss. Now, very important, sir. Once you know the impairment loss of the CGU, first you need to allocate with goodwill. If goodwill is not there, in this case, goodwill is not there. So in the cash generating unit B, what is the impairment loss, sir? 66. So this 66, what you need to do is, what are all the assets in this B? For those assets, you need to allocate. So this 66, see how they have allocated between the assets. In the cash generating unit, the first asset is corporate asset X, other assets. So whatever be the value, carrying amount. So in case of B, 750, 260. So in this ratio, they have allocated. Okay, see here, 750, 260. Total 966. So this 66 impairment loss is allocated between the assets in the cash generating unit in their carrying amount. Similarly, cash generating unit C, what is the impairment loss? 12. Now this 12 we need to allocate between the assets in the cash generating unit C. So in cash generating unit C, 1100, 312. Two assets are there. 1100, 312. So 1100, 312. This 12 is the impairment loss. They allocate it based on the carrying. So 3, 9. So this is the thing. So therefore, what happens now? This impairment loss will be deducted from this particular asset. That is what they have done here. So therefore, the idea is corporate asset X alone, independently, it is not possible to test for impairment. But now we have allocated this X between the cash generating units and we tested for impairment. That is called testing of impairment of an asset in CGU. So alone it may not be possible, but as a group it is possible. Now once you know the impairment loss of the group CGU, then this impairment loss will be allocated. First you need to reduce from goodwill, because in this question goodwill is not available. What we need to do is this impairment loss will be allocated between the assets in the cash generating units based on their carrying amount. Now my request to everyone is to solve this question once so that you will get the clarity. So this is problem number 8. Okay. Now, so the last concept of this standard is reversal of impairment loss. Okay. So till now we have discussed about impairment loss for individual asset as a group CGU. Now reversal of impairment loss. Suppose there are indicators, internal indicators, external indicators, which are very adverse, negative. So we booked impairment loss. We tested for impairment, and if you feel, if we arrived, our carrying amount is more than recoverable value, we recognized as our impairment loss. Suppose, what about situations reversed? So negative things has become positive. So internal sources, external sources. So their internal sources, you see, everything is adverse. Here you see positive. See here, significant changes with a favorable effect on the assets usage or operation. Evidence of better than expected economic performance. Evidence shows that this asset is generating better than what we have expected. Or cost incurred to improve or enhance the asset performance or restructuring its operations, which will again have a positive impact on the organization. We have spent an amount on the assets enhancement, which will in turn increase the assets performance and organization cash flows. So these are all what internal sources, and everything is what positive. Then you can reverse the impairment loss. See, once you booked an impairment loss, because there are negative signs, but now there are positive signs. When there is a positive signs, you need to reverse the impairment loss. That means maybe your recoverable value has been improved. What happened is your carrying amount is greater than recoverable value. So you said, since whatever the excess is there above the recoverable value, that is my impairment loss, you booked. But now the situations are improving. So when the situation is improving, your recoverable value gradually increases. So therefore, whatever the impairment loss you booked, so you need to reverse it. That means whatever the asset value you decreased, now you need to increase the asset value. And what are the external sources? Significant increase in asset value. There significant decline in market value of the asset. Favorable changes in the technological, market, economic, legal environment. There adverse situations. Decreased interest rates. There increased interest rate. I told that real estate example. So therefore, these are all positive things. So when reversal of impairment loss will be done? Simply by passage of time, you cannot book reversal of impairment loss. When you want to book the reversal of impairment loss, again you need to increase the asset value. Previously, you reduced the asset value because of its impairment. The situations must be improved. The positive things must appear. The internal and external sources must appear again. Then you can look for the reversal of impairment loss. Okay. So what happens in reversal of impairment loss? See, in general, impairment loss is reversed if and only if there has been a change in the estimates used to determine the assets recoverable amount. So when the recoverable amount is improved, then only reversal is possible. Carrying amount of the asset is increased to its recoverable amount. Yes. Increase must be done to its recoverable amount. Impairment loss is not reversed just because of the passage of time. Even if the recoverable amount of the asset becomes higher than its carrying amount. So just because of the time, you cannot reverse. You need to find out any one of these sources. Then only you can go for reversal of impairment loss. Now, first you take individual asset. So previously the asset was, impaired. You booked the impairment loss. Now the situation is improved. You found out one of the positive factors. So you want to reverse the impairment loss. Yes, you can. But again, you need to see whether the asset is previously revalued or not revalued. Same as in the initial impairment loss booking, what is the treatment? The asset is not subject to revaluation. That means there is no revaluation surplus. Then I said impairment loss totally will be transferred to P&L account. Suppose if there is a revaluation surplus against that asset, first I said impairment loss will be adjusted against the revaluation surplus in the other comprehensive income. Then excess impairment loss will be charged to P&L account. Similarly, here when you are reversing the impairment loss also, you have to be very careful, especially in regarding an individual asset. If that asset is without revaluation, there is no revaluation surplus, then reversal can be, see, on reversal, the increased carrying amount of the asset other than goodwill, because goodwill, there is no question of reversal of impairment loss for goodwill. So that's why see here in this chart, goodwill it is not permitted. So once you book the impairment loss for the goodwill, the reversal of impairment loss concept is not applicable for goodwill. Ignore it. So on reversal, the increased carrying amount of the asset due to reversal of impairment loss shall not exceed the carrying amount. Net of amortization depreciation had no impairment loss been recognized for the asset in prior years. Now, when you are doing the reversal of impairment loss, one golden principle is you have to increase the asset value only to that an extent that suppose if you have not provided any impairment loss, what will be the carrying amount of the asset? So that will be your limit. That will be your benchmark. I am going to give you one practical example. Wait. So a reversal of impairment loss is recognized immediately in P&L, and any increase in the excess of this amount could be revaluation accounted for under appropriate standard. Okay. Suppose if asset is with revaluation, suppose if there is a revaluation surplus against that asset. So, and now you are doing the reversal of impairment loss. What you need to do? A reversal of impairment loss on revalued asset is recognized in other comprehensive income and increase the revaluation surplus of that asset. There is a revaluation surplus. Again, you are doing the reversal. So, adjust it to the revaluation surplus. After reversal, the depreciation amortization charge for the asset is adjusted in future periods on systematic basis over its remaining useful life. To the extent that impairment loss on the same revalued asset was previously recognized in P&L, a reversal of that impairment loss is also recognized in P&L account. Okay. Let me take one practical example and solve so that you will understand it better. Take problem number 4, sir. A Limited purchased an asset 100 lakhs on 1st April 2010. Okay, they purchased one asset, sir, 100 lakhs worth of asset on 1st April 2010. It has a useful life of 4 years with no residual value. Recoverable amount of this asset is as follows: 31st March 2011 60, 31st March 2012 40, 31st March 2013 28. Calculate the amount of impairment loss and its reversal, if any, on 31st March 2011, 31st March 2012, 31st March 2013. Okay. So what we need to do? We need to book the impairment loss. So tell me generally how you are going to calculate the impairment loss. So you need to compare the carrying amount with recoverable value. When the carrying amount is more than recoverable value, there is an impairment loss, right? In this case, this is question 4. Come to question number 4. So first year end 31st March 2011, right? Tell me what is the value at which you purchased the asset? 100 lakhs on 1st April 2010. What is the useful life? 4. So first year depreciation 100 divided by 4. So 25 lakhs. So 100 minus 25. So 75 lakhs is the carrying amount at the end of the first year, right? See here. 100 depreciation for the first year 25. So 75 lakhs. What is this? This is the carrying amount of the asset. You compare this carrying amount with recoverable value. Recoverable value at the end of the first year 60 lakhs. 60. So carrying amount is greater than recoverable value by 15 lakhs. So therefore first year impairment loss 15 lakhs. You understood? Very simple. First year, at the end of the first year, carrying amount 75, recoverable value 60. So carrying amount is greater than recoverable value by 15 lakhs. So that 15 lakhs is my impairment loss. Okay. Now come to second year. Second year, what is the carrying amount? Another important. Listen. Second year, what is the remaining amount, sir? Remaining amount. What is the carrying amount? 60 lakhs, because 75 you reduced impairment loss 15 lakhs. So 60 lakhs. And the 60 lakhs will be depreciated over the remaining life of 3 years. So the depreciation for second year is 20. 60 divided by 3. So therefore, what is the carrying amount at the end of the second year? 40. Recoverable value 40. So therefore, there is no impairment loss. Have you understood, sir? Most of the students they are missing here. See, first year, what is the impairment loss? 15. That means you need to reduce the asset value by 15 lakhs. That means your asset value is now 60 lakhs only. 75 minus 15, 60 lakhs. What is the entry here? Impairment loss account debtor to asset. This impairment loss will be transferred to P&L. So therefore, what is the carrying amount at the end of the first year? 60 lakhs. Now these 60 lakhs will be depreciated over the remaining life. Out of 4 years, first year is over. Remaining life 3 years. So 60 divided by 3, 20 lakhs is the second year depreciation. So 60 minus 20, 40 lakhs is the carrying amount at the end of the second year. Recoverable value also 40 lakhs. So when the carrying amount is equal to recoverable value, there is no impairment loss. Now come to third year, 31st March 2013. Can you tell me what is the third year carrying amount beginning? 40. This 40 will be depreciated over the remaining 2 years. 40 divided by 2, so 20. So carrying amount 20 lakhs. What is the recoverable value? 28 lakhs. Now everybody please focus. Understand the concept of reversal of impairment loss. So first 2 years, sir, first year your carrying amount is greater than recoverable value. So you said 15 lakhs impairment loss you booked. You reduce the asset value by 15 and that impairment loss you transfer to P&L. Second year your carrying amount, recoverable value both are same. So there is no impairment loss. But third year your carrying amount is 20 but your recoverable value is 28 lakhs. So that means the recoverable value has been increased. But the carrying amount is only 20. So what we need to do? We need to reverse the impairment loss. So that means we need to what extent? We need to reverse the carrying amount of, we need to increase the carrying amount to the extent of recoverable value. That means actually our carrying amount is 20, but recoverable value 28. So we need to increase the asset value by 8 lakhs. We need to increase the asset value by 8 lakhs. But that is wrong. Why? Because the standard says in case of reversal of impairment loss, you need to increase the carrying amount up to recoverable value, but subject to what is the carrying amount of that asset if you have not provided depreciation. Therefore, suppose what is the carrying amount of this asset at the end of the third year? Suppose if there is no impairment loss, original cost 100 lakhs. If I depreciated it over the period of 4 years, first year depreciation 25, second year 25, third year 25. That means by the end of the third year, what is the carrying amount of this asset? 25 only. But your recoverable value is 28. So therefore, you cannot increase the asset value by 8 lakhs. You can increase only up to 5 lakhs or increase by 5 lakhs. Fair enough, na sir. Sir, suppose if there is no impairment loss, what is the carrying amount of the asset at the end of the third year? 25 lakhs. But now what is the recoverable value? 28 lakhs. So therefore, you need to increase the asset value up to recoverable value, but subject to original carrying amount. That means if there is no impairment loss, just you provide depreciation on that asset. What is the carrying amount? Only up to that. So that is the original value of the asset. Therefore, here you should not increase 8 lakhs. You should increase only 5 lakhs. So therefore, reversal of impairment 5 lakhs. That means what is the entry here? Asset account data to reversal of impairment loss 5 lakhs, 5 lakhs. You need to increase the asset value by 5 lakhs. Sir, why can't 8 lakhs? Only 5 lakhs. Because imagine this asset without impairment loss, what will be the value at the end of the third year? 25 lakhs only. But what is the carrying amount now? 20. But what is the recoverable value? 28. Therefore, I need to increase the asset value. That means I need to reverse the impairment loss. But to what extent, sir? 8 or 5 or 5. Because the standard says you can increase the asset value. You can reverse the impairment loss. Maximum up to recoverable value subject to original carrying amount. As if this asset is not subject to impairment. If you provide just depreciation amortization, what is the carrying amount of the asset? 25. So therefore, you need to increase the asset by 5 lakhs. That means you need to reverse the impairment loss only by 5 lakhs. So that is what I'm saying here. So that is the concept. And I am going to solve one more question, sir, so that you will understand it better. Question number 14 I am going to solve. Question number 14 actually December 2023 exam question, sir. See here. Coel Limited acquired a mission on 1st April 2012 for 14 crores that had estimated useful life of 7 years. Okay. The mission is depreciated on straight line basis and does not carry any residual value. Okay. On 1st April 2021, that means 17, 18, 18, 19, 19, 20, 2021, 4 years over. The carrying amount of the mission was reassessed at 10.2 crores and surplus arising out of the revaluation being created to revaluation surplus. That means this asset is subject to revaluation surplus. This asset is already revalued. For the year ending 31st March 2023, after 2 years, conditions indicating an impairment of the mission existed and the amount recoverable ascertained to be only 1.5 crores. The company had followed the policy of writing down the revaluation surplus by the increased charge of depreciation resulting from the revaluation. So what is the policy of the company? So the policy of the company is writing down the revaluation surplus by increased charge of depreciation resulting from revaluation. That means this revaluation surplus they written off over the period by in the form of depreciation. Obviously, na, because revaluation surplus will increase the asset value. You are required to calculate the loss on impairment loss of the mission and show how this loss is to be treated in the books of KOEL Limited. So this is question number 14, sir. December 2023 question. Yeah. Very good question. Actually, this is examination question. I solved in my class elaborately. So see this, I will give you a brief idea about it. Sir, what is the original cost of the asset? 14 crores. When? 1st April 2017. 14. And what is the life? 7 years. No residual value. 14 divided by 7. That means every year depreciation 2. So on 1st April 2021, you purchased on 1st April 2017. So 17, 18, 18, 19, 19, 20, 2021. Every year depreciation 2 lakhs, 2 lakhs, 2 lakhs, 2 crores, 2 crores, 2 crores, like that you provided. So after 4 years, what is the carrying amount? 6 crores. So on 1st April 2021, the mission was revalued at 10.2 crores. So 10.2. But what is the carrying amount? 6 crores. So therefore, what is the increase in the value of asset? 4.2. This is called revaluation surplus. Obviously, when you increase the asset value by revaluation, that excess amount, whatever the asset value you are increasing now, that is called revaluation surplus, 4.2. Now, next what happens here? After 2 years, 31st March 2023, conditions indicating an impairment of the mission existed and the amount recoverable ascertained to be only 1.58 crores. After 2 years of this happened, so revised carrying amount on 1st April 2021, 10.2. And this is depreciated over 3 years because out of 7, 4 years are over 3 years. So 10.2 divided by 3. So what is the depreciation for 2021? 3.4. 21-22, 3.4. So carrying amount on 31st March 2022, 3.4 crores. Now you need to test it for impairment because on 31st March 2023, so our carrying amount 3.4 out of 10.2 on 1st April 2021, 2021, 21, 22. 2 years depreciation if I reduce, the carrying amount is 31st March 2022, 3.4. And the recoverable value they given in the question 1.58. So carrying amount is more than recoverable value by 1.82. So the impairment loss is 1.82. So therefore, what is the entry? Impairment loss to mission 1.8. But see, the concept here is this 1.82, first we need to adjust against the revaluation surplus. Balance only we will transfer it to P&L account. So therefore, out of this revaluation, out of this impairment loss of 1.82, what they have done is up to 1.4 crores, they adjusted to revaluation surplus. And balance they transfer it to P&L account. Right? Balance they transfer it to P&L account. When see, because in the they have a revaluation surplus, we have calculated. What is the revaluation surplus here? 4.2 crores. That this is the revaluation surplus. But after that, if you provide 2 years depreciation, so what is the revaluation surplus balance amount? 1.8, 1.4. So first we need to adjust against the revaluation surplus balance, and the remaining balance we will charge it to P&L account. So that is what we have done. 1.82 crores. So 1.4 we adjusted with revaluation surplus. Balance we charge it to P&L account. So increase in depreciation because of revaluation surplus. So 3.4 is the depreciation amount, right? Normal depreciation is only 2 crores. See, in the question they clearly said that the company had followed the policy of writing down the revaluation surplus by increased charge of depreciation resulting from the revaluation. Now, because of this revaluation surplus, whatever the depreciation is there, that was charged in the form of depreciation. Therefore, our depreciation is 3.4 crores after revaluation. But actually, suppose if there is no revaluation, what will be the depreciation? Only 2 crores now. Initially, we calculated 2 crores. If there is no revaluation of asset, every year the depreciation is only 2. That means because of the revaluation, what is the excess depreciation? 1.4 crores. Now, that excess depreciation, whatever we have charged in the form of depreciation, so what they have done is first they adjusted to that revaluation surplus and then balance they charged to P&L account. See here. So impairment loss set off against the revaluation surplus 1.4 and balance they charge it to P&L account 0.42. Actually, in the suggested answers they will give direct answers, sir. They won't explain all these things. But this much we need to do. Okay, so this is one more question, sir. So very good question actually. I have given a brief idea about this. So here basically there is an impairment loss of 4, revaluation surplus of 4.2. You may ask, sir, this entire impairment loss, why you have not adjusted with revaluation surplus? Because in the question they clearly said that, see here, the company had followed the policy of writing down the revaluation surplus by increased charge of depreciation. So in the question clearly mentioned that this revaluation surplus they have charged, writing down the revaluation surplus by increased charge of depreciation. So therefore what we need to do is, after revaluation of the asset, what is the depreciation increase? 3.4 crores. What is the normal depreciation? Only 2 crores. So therefore what will be the excess? So excess 3.4, 2 crores. So excess is 1.4 crores. So that excess only we adjust it. Remaining we transfer it to P&L account. Whenever you are doing the reversal of impairment loss, in respect of which there is a revaluation surplus, what is the revaluation surplus balance available? Because the total revaluation surplus is 4.2. Out of 4.2, excess of depreciation is 2. So therefore, for excess of depreciation 1.4. So what will be the balance? 2.8. Actually 1.4 is for 1 year, sir. Like this for 2 years, if I provide 1.4 into 2, 2.8 is the excess depreciation. So 4.2 minus 2.8 will be 1.4. So that's why 1.4 we adjusted. Remaining we adjusted to P&L account. Because our revaluation surplus total 4.2, sir. How much it is charged in the form of depreciation? So after evaluation 2 years depreciation, first year 3.4, next year 3.4, but normal depreciation 2.2, that means 1.4, 1.4, so total 2.8 extra. So out of 4.2, 2.8 charged in the form of depreciation, what is the balance in the revaluation surplus? 1.4. So therefore out of your impairment loss of 1.82, we adjusted 1.42 against the revaluation surplus, and balance we charged to P&L. Okay, see, look at the depth of questions they are asking, sir. So that's it, sir. That's about this standard. So I have revised quickly the entire standard, and I have given brief idea about the questions. Now it is your turn. You have to, listen to this revision once or twice and then try to solve the questions. And understand, students, this is only a revision series. Most of the students are expecting that, or most of the students what they are thinking is just markers and revisions will be sufficient. No, understand, these are sufficient only once you have covered the entire syllabus. So suppose if you are listening first time, so understand this is not for the first timers. You cannot expect this many big standards. Impairment loss is not an easy standard, so this is a huge standard. Don't expect that this will be completed by 1 hour or 1.5 hours. So just by listening first time you will not get through these standards. So if anybody is listening to this for the first time, if you will definitely get a lot of doubts. So but understand this is only a revision series. Okay, and we have time constraint here. I can't revise the one standard for, actually in my classroom this standard alone will be discussed around 7 to 8 hours, but here I have to do it in within 1 to 1.5 hours, because this is a revision. Otherwise it will become a normal class now if I do it for 5 to 6 hours. So understand the limitations of revision.